Carmen Balber. I'm the Executive Director of Consumer Watchdog.
Tell me a little bit about what is the sustainable insurance strategy and what does it mean for consumers?
The sustainable insurance strategy is the insurance commissioner's plan to address the home insurance crisis in California. Unfortunately, what the commissioner's plan would do is a wish list of the insurance industry that they've been pushing in California for decades. The insurance commissioner is counting on the insurance industry to, out of the goodness of its heart, come back into California if just we give them everything they want. But we don't have faith that giving the insurance industry everything it's asked for is a way to coax them back into the market. In fact, we know it's not the way, because every element of the insurance commissioner's plan has been tried and failed to stabilize the market in other states, Florida specifically. In Florida, they have every element of the commissioner's plan. They still have rates that are 2.5 times higher than ours, 4 times as many people in their version of the FAIR plan, and the main insurance companies haven't come back into the state. So that solution is not going to get Californians access to affordable coverage again.
Well, let's jump to the end of my question, which was what the solution is. Because these companies are leaving California and dropping customers.
Absolutely.
I mean, how do you get them to come back?
It's a real crisis for homeowners, for business owners, for condo owners and renters in California, because they're having harder and harder time getting insurance. And when they do find insurance, it's prohibitively expensive. So people have to cut their coverage, cut corners, not pay other bills in order to cover their insurance. So this is absolutely a crisis for Californians. Here's our solution. If the home insurance industry wants to do business in the 4th largest insurance market in the world, they should be required to sell to Californians who do the right thing and protect their homes from wildfire. One of the biggest complaints we hear from consumers is that they say, I spent a fortune, thousands or even tens of thousands of dollars hardening my home, clearing brush around it, cutting down trees, replacing the roof to make sure my home doesn't burn down in a fire, and they still got canceled. That is outrageous. People who do the right thing not only protect themselves, but their neighbors by hardening their home against fire deserve access to coverage, and we don't have that in California right now. We need a mandate that says if you want to sell home and auto insurance in California, you have to sell to Californians and communities that harden their homes. That will get insurance companies back into the market.
Well, if you tell the insurance industry that you must cover people, how is that going to make them come back to the state if they've already pulled out?
They will be required to, if they want to sell the insurance policies they sell here in California today, in both the home and auto insurance market, they have to cover those other people as well. In auto insurance in California, every auto insurance company has to sell to every good driver. If you're a good driver in California, you can go to any company in the state and they must sell you coverage. We have the same protections in health insurance. Obamacare said insurance companies cannot deny you for pre-existing conditions. They have to take all comers. We need those protections in home insurance because it really is a mandatory product for anyone who doesn't own their home outright.
Do we say that you can't issue auto insurance in California if you don't issue homeowners wildfire insurance?
That's what we would say because that's the stick. That's what keeps the companies in the market.
They make a lot of money on homeowners, on auto insurance?
Historically, home insurance companies and auto insurance companies have made a lot of money in California. And I think this is something that is really important to note as well and is very contrary to the story the industry is putting out. Home insurance companies in California over the past 2 decades have been more profitable than the average nationwide. More profitable in California than they are across the country. It really belies this image that the industry is putting out there that they're going bankrupt in the state of California. They are not. Now, did they have 2 really bad fire years in 2017 and 18? Absolutely. But the piece of that story that they don't tell is that they also got repaid a big chunk of that money by PG&E and Edison, who were responsible for some of those losses to the tune of at least $12 billion. And so the insurance industry is not doing as bad as they claim. And we can hold their feet to the fire and should be to cover Californians who haven't done anything wrong.
Now, I don't want to get in the weeds on reinsurance, but if they are allowed to charge consumers for reinsurance or actually use that in their rate increases, does that mean that rates are going to go up for consumers?
Guaranteed. The last estimate that was put into the legislature by a national insurance expert was that rates would go up 30 to 50% overnight. An actuary that consults for Consumer Watchdog works on reviewing home insurance rates in North Carolina. He pulled out a recent filing, and the reinsurance portion of that rate increase was 39%. Passing through the unregulated global cost of the reinsurance market in California will mean huge double-digit rate increases overnight. And that's really not going to be acceptable or tenable for most California homeowners. So the bottom line for not only the reinsurance portion of the commissioner's plan, but the commissioner's whole plan is that it guarantees huge rate increases for homeowners, but it does not guarantee that anyone is going to have access to coverage again.
Well, let me go back to my other question again, but he's going to say that these companies are not here right now. We need to bring them back, force competition, and it will lead to more availability and affordability. How do you respond to that?
Simply giving the insurance industry everything they want does not mean they will come back into California and make the state more competitive again. That's the whole crux of the commissioner's argument that, oh, if we give the industry everything they're asking for, then they're going to come back here and there's going to be competition and rates will go down again. That is not going to be the result of the commissioner's plan because he still allows the insurance companies to control the game. They can decide who they sell to and whether or not they're going to take into account the tens of thousands of dollars homeowners spend, the millions communities spend, and the billions the state spends on protecting our state from wildfire. And if the insurance industry is in charge, if the insurance industry is driving the train, we're going to have more of the same. And it's critical that the commissioner's quid pro quo, the supposed commitment to come back into the market that he says he extracted from the industry, is so full of holes, it's useless. That commitment is full of loopholes and will not hold insurance companies to those commitments. So that again means no expanded access to coverage. And a year from now, we'll be in the same boat as we are today, where consumers are having trouble finding or affording their home insurance.
Well, what's wrong with the Commissioner Laras' idea or mandate, as he says, that if they come back and they're allowed to use catastrophic models, that they have to insure 85% of people in distressed areas? Is that not going to happen?
The regulation doesn't say that. The commissioner has told everyone across the state that insurance companies will start selling to 85% of distressed areas again. His regulation does not require it. It says companies will make a commitment to sell to 85% of wildfire areas again. Or instead, they can choose to only increase their sales in those areas by 5%. Well, you can easily see if you're an insurance company who basically pulled out of the riskier parts of California, that increasing your sales in that area by 5% could be negligible. Then there's a third alternative, where the regulation says insurance companies can say, I don't like 85%, I don't like 5%, I'm going to choose an alternative commitment, which is undefined, so the insurance company gets to make up what that commitment is. That's the first loophole. 85% is not set in stone. The regulation gives insurance companies other options to choose from. So that first piece of the commissioner's promise is a lie. After that, companies have 2 years to show they've met whatever commitment they make. So that pushes us all the way into 2027. And when that date rolls around, insurance companies can come in and say, sorry, I wasn't able to meet my commitment, but I made, and this text is in the regulation, a reasonable effort to make that commitment. Then the insurance commissioner can simply move the goalpost for the company.
So it's not set in stone.
It's not set in stone.
He said in his interview with Cal Matters that this 5% is really only meant to apply to smaller companies, and implying that he's still going to hold the larger companies to that 85%. But you're saying there's loopholes?
Yes. The regulation doesn't say anything about the 5% being specific to smaller companies at all. And because of that, the insurance companies will be able to hold the insurance commissioner to what the regulation says. So even if he is acting in good faith and intends for the 85% to apply to all insurance companies or the largest insurance companies, it's not what the rule says. So insurance companies will be able to use those exceptions.
Does it seem to you the insurance commissioner is siding with the insurance companies as opposed to the consumer? And if so, why do you think that is?
I can't speak to the commissioner's motives. All I can say is that the plan that he has put out is 100% for the industry and has nothing for consumers in it. He has absolutely sided with the industry in this plan. He has taken their solution to the problem that they created by pulling out of markets and is proposing it as the department's plan moving forward. And taking the insurance industry's plan writ large and saying that's a consumer protection is an oxymoron. That's not what is going on here in California. The insurance industry is holding California hostage in order to change the rate oversight rules in California. The industry is continuing to hold California hostage because they want an out from the regulations that have kept rates fair and stable in California for over 3 decades. So absolutely. Did the industry here and across the country also face big cost increases and react by saying, ooh, we're not going to sell so many policies? Absolutely. That is happening too. But the reason California is stuck in this position it is, the reason California is looking like an anomaly because of how insurance companies are treating us when really their experience here is better than it is across the country, is because the industry has California's public protections in its hair sights, and it wants to get rid of that law. And so that is absolutely what's going on here. The insurance industry has rate oversight in its sights, and it's squeezing every lever to try and get rid of this law that they have disliked for so long.
All right, well, one of the elements of the strategy is speeding up rate review process. What's wrong with a faster rate review process?
Nothing is wrong with a faster rate review process, and we support that, as long as the insurance companies still have to provide all the data they're supposed to prove their rate is justified. So Prop 103 said you have to, California's law that the voters passed said you have to open your books and justify your rates and get the insurance commissioner's approval on those rates. It also said that everything that goes into a rate has to be transparent and that the public can also participate in that oversight process, and Consumer Watchdog does that. Over the last 2 decades, we've saved $6 billion in what would have otherwise been excessive auto and home insurance rate increases. And over time, those rate reviews have started taking longer. We have no problem with speeding up the rate oversight process, but the proposals that the commissioner has put out in the past would allow insurance companies to escape the mandate that they give the commissioner and public participants like us all of the information they're supposed to prove their rate is justified. And the commissioner is trying to limit public participation in that process because he says that consumers don't need anyone but him. I think the voters and certainly our organization would disagree.